Hey friends, Dan Passarelli here. How are you feeling today? I hope you're feeling great, and I hope you're ready to fix some mistakes. Mistakes maybe that you didn't even know you had. Geez, what kind of mistakes could those be? Oh my gosh. Well, we're about to find out today, aren't we? Before we get started, I want to make sure you can hear me. If you can hear me, please hit that Q&A box and type the number 81. Type the number 81. Mike is back. Julia, Stephen, Justin. He's here just in case. Chris, here. Nathaniel, David, Salen, Larry, my man. Oh, Larry's here. That's great. I'm glad Larry's here. Joe is here. Secret Agent Man Anonymous Attendee is here. Yishi is here. Afalabi, hope I said that right, is here. If not, just type it phonetically and I won't screw it up again. Or at least I'll try not to. Okay, welcome, friends. Boy, oh boy, do we have a lot of great stuff to talk about. Oh, good. All right. Now, before we get started, I need to point out that options are not for everyone, specifically you right there. No, not you. To your left. Yeah, it's not for you, but everybody else, it might be for you. Um, Before you decide, you should read characteristics and risks of standardized option before trading. Get a copy of that by emailing investor services at the OCC.com. And don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. All right. Clearly, I see a lot of market taker family members here, and that is wonderful. And really, I see every one of you is part of the market taker family now. But those of you who are new members of the Market Taker family, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular trading books. The one that I'm mainly known for is Trading Option Greeks. It's been called one of the top 5 option trading books written by actually a number of sources. And I'm honored to have that distinction. And I write a ton on Substack under Wealth Building with Options. And oh my gosh, I am a content creating machine. I create a lot of content. I'm also a trader. I've traded for years on the trading floor of the Chicago Board Options Exchange. Now I trade in a retail account just like you. And since leaving the trading floor, I have founded Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries. We have put over 10,000 people through our classes. Or is it 20,000? I don't know. It's a lot of darn traders that we have helped over the years. And not just with market taker mentoring, but also with other leaders in the industry I collaborate with a lot. The good options friendly brokerage firms out there like Firstrade, BTW. I work a lot with Firstrade. I've worked with other options friendly brokerage firms and exchanges worldwide. And what else? Oh, I do other things for fun besides trading and helping traders. I've got a family. I've got my wife, Kathleen, who those of you who are subscribed to a market taker class or on our email list, You know Kathleen, she runs operations here at Market Taker. She straightens everything out. She's in charge of, well, running the show, basically. And I also have my two adult children, Sam and Isabel, who are out of the house. They flew the nest for about the third time each for each of them. And I've got my two little cute dogs. Where's the one? Oh, she's usually in here taking a nap, but she's not right now. And I'm also do other things for fun. I'm a runner. I've been biking lately because my foot hurts. I am a foodie. Love to eat. That's why I need to exercise. A traveler, been all over the world. And I'm a music person as well. All right. Now, enough about me. Let's talk about the important person here. Let's talk about you. In addition to what we're doing here today, I want to help you even more than I can do in an hour. So if you go to markettaker.com, it's market as in stock market, taker as in take what's rightfully yours, two T's in a row, markettaker.com. And just go up to the top right hand side, click on join free. That'll get you on our email list where we send you our weekly newsletter, invitations to complimentary online trainings, and you get lots and lots of free classes. It's an incredible benefit, and I'm honored to have the opportunity to give that to you for free. Okay. So let's talk about some of the challenges of trading options. I don't know if you're aware of this, but trading options isn't always easy. Yes, I go out of my way to try and make it as easy for you as possible, and I've definitely simplified a lot of the things for you. But there's a lot of challenges. One is, I don't know anybody who has a crystal ball. Do you? I don't. I don't. I did meet a guy who has a glass eyeball, but he couldn't see the future. So since you can't see the future, you have to do your best to forecast. Your glass eyeball broke? Hope it wasn't in your head when that happens. You should get one of those snow globes and you can like shake your head and show the kids. That'd be kind of fun. That's what I would do if I had that situation. Um too much snow. Okay, so we have to be good at forecasting the market. And geez Louise, that's not easy. We also need to understand not just how technical analysis works, how fundamental analysis works, not just form a good opinion on the stock itself. We need to deeply understand options. Trading stocks, it's checkers. Trading options, that's chess. And I'm going to tell you something in a way that could sound intimidating. And hey, you know what? We all got to be up for a challenge in life. Let it feel a little bit intimidating, but don't let it feel that intimidating because you know why? Because when things are a little tricky, it keeps other people out and it keeps it keeps the people who don't put in the effort, like you guys. I mean, you're here, you're putting in the effort to learn. You're a step ahead of 90% of the traders out there. And I'm not saying that just to be nice. I don't have to be nice. I just have to do a good job teaching you stuff. I'm not saying that just to be nice, but there are a lot of traders out there who don't do what you do. They don't educate themselves. They watch some half of a 5-minute YouTube video and say, oh, okay, I get options. I'm going to put all my money into buying these calls. Got a hunch, bet a bunch. Hunch is wrong, bunch is gone. And that's okay for them, but not for you. Options education is very, very important. Still, while you're going through the education process, you might make mistakes. And mistakes cost money. And that goes back to education. I don't remember who it was who said this, but they say if you think education's expensive, try ignorance. The market is a terrible teacher. You can try trial and error trading on your own, and you're going to lose money. But you'd probably think about that as part of your education. Learn from the black and the blue. But here's the problem. When you screw up just doing trial and error with the market takes your money, but it doesn't tell you what you did wrong. And they're going to just take it again the next time and the next time and the next time until 15 times later, you might figure out what you did wrong, or you might not. Education is way cheaper. But again, still, as you're learning, you're going to make mistakes. And sometimes those are one-time mistakes where like, oh, I see what I did wrong. I'm never going to do that again. And some are those recurring mistakes where the market didn't teach you well. So let's save you massive amounts of money. Because even if you're investing your time in education like you are here today, and financially in education, which you're going to have to do as well, you're still going to be trading while you're doing it. You're still going to make some mistakes. Mistakes add up. The difference between a winner and a loser, that's one tiny little mistake. The difference between a good year and a bad year, it's one tiny little misunderstanding. The difference between ultimate success and ultimate failure, giving up, that can be one little thing that you didn't get right. Isn't that pretty profound? And sometimes they're seemingly little things, but they say little hinges swing big doors. I used to work on the trading floor with somebody back when options used to trade in teenies. Anybody know what a teenie is? Type in the box the answer. What's a teenie? What's a teenie? Anybody know? You never know. I'm known to sometimes give out prizes. If I mail things, though, and you're outside the U.S., it doesn't always end up in your hands. So I can only give prizes to people who live in the U.S. Unless you want to come here, then I'll hand it to you personally. No, nobody knows what a teeny is? Okay, that's okay. It's pretty antiquated. That's when options used to trade in sixteenths of a dollar instead of pennies. Every 16th of inexpensive out of the money. Yeah, exactly. It would be 1/16th of a dollar, which is $6.25 of actual money. $6. So basically like a nickel. I used to work on the trading floor with the guy who used to say, what's a teeny? You know what a teeny is? That's the difference between where I live and you live. It's pretty good, right? He was a good trader. The difference, that little difference of basically a nickel, can be the difference between living in a big house doing nothing besides trading and struggling and suffering and being frustrated with your trading and not being able to quit your day job. So, we're going to talk about some common trader mistakes. Choosing the wrong teenies to protect against black swan events. Oh, yes, Baron. Thank you very much. I like that. I like it. I like it. I like it. So we're going to talk about some common trader mistakes today. Choosing the wrong expiration cycle, choosing the wrong strike price, holding on to losing trades too long, taking profits too soon, not trading with the plan. I ran out of fingers, not using the wrong or using the wrong option strategy, misallocation of capital. Let's get into it, friends. Choosing the wrong expiration cycle. It seems like a pretty benign thing, but I'll tell you what, it matters. There's a lot of different expirations to choose from in some stocks. You're trading some of the indexes and ETFs. Some of them have expirations every day, and they're talking about adding expirations every day to the Mag 7 plus Broadcom. How do you know? Monthlies, weeklies, quarterlies, leaps, dailies. How do I know which expiration is best? Is there a right answer to which expiration cycle to choose? Well, yeah, there is. And sometimes, if you're close, it's okay. And sometimes there's a line in the sand where this one's good and that one's terrible. Say there's a trader, Larry, not the Larry we know, a different Larry. Larry, quite contrary. That's his last name, quite contrary. What is that, Italian? Does it end with an I? Contrari. Hey, Larry Contrari. Okay, so Larry Contrari, he's an income trader, right? And no, different Larry. Unless, wait, you're not contrary, Larry. You're like the most amicable, nice guy I know. Come on. All right. So, Larry Contrary, your wife says so. Oh, just give her a big smooch on the cheek when she says that. She'll change her tune, turn that frown upside down. All right. So, so Larry's an income trader, and he sold some credit spreads. And the last credit spread he sold expires 5 months from now. Could there be a problem with this? Well, maybe, right? Options with a long time until expiration can decay very slowly. Time decay is what leads to potential profit when it comes to credit spreads and time spreads, iron condors, butterflies, any of the income trade family. Theta. Larry Contrary, his trade was flawed, possibly, because he might not be making as much as he should. He could be leaving on the table money on the table with his winners. And over a lot of trades, that adds up. But you guys get the extra bonus content. What I just said is what any decent option teacher ought to tell you just as a minimum baseline. But I'm going to go above and beyond a little bit here. Because when it comes to theta, it's the rule of thumb that, hold on a second, I'm trying to log into my Firstrade on the other screen here. It's a rule of thumb that close to expiration has higher theta, but it depends on some things. It depends on how far from the strike and such. Now, if we just look at what's in the presentation here, and this is for like just the regular traders, not the special traders like you who get the bonus content. If I am selling like the 235 strike calls as part of a credit spread, if I sell the 21 days to expiration, I don't know. I had John put this together today. John must have been drinking again. Hold on a second. John, what the even heck? I'm going to send this to him right now. John, why are you messing things up? John never messes things up. John is like, John is one of the smartest and best traders I know. But everybody makes mistakes. Bon, what's up? Not you. Okay, so on this 21 or 20, we'll just call it a 21-day option. No, no. John Kamisic, our head coach. John Kamisic is an ex-Goldman guy. He leads our daily group coaching class. Yeah, at 10 Eastern time every day for an hour. Those of you who do go to markettaker.com and click on join free, I think you'll see a special trial link where you can try that class out for 99 bucks. Hey, Robert, what's up, man? I appreciate being here and I appreciate being appreciated. All right, so look, if this person sold this like 21-day call at $4, well, is going to make what the hell is John talking about? 4 divided by 21. Well, basically, the moral to the story is he's going to make more in. Oh, well, here's the way to think about it. Oh. Yeah, here's no, John. Oh, see, look, you want to talk about mistakes? John did it right. I made the mistake. I'm eating crow. Do you believe that? John outsmarted me. He does that sometimes. John's a great trader. You can't work for Goldman Sachs if you're not a if you don't know a little something, right? So these are 514-day options. Yeah, that's right. Yeah, that's right. Thanks, Dirk. Do you believe it? So 514 days, over 514 days, if I sold the 235s, I'd make $36.6. But there are 21 24-day periods in 514. 514 divided by 24 is 21. So if I sold a 24-day option at $4 and did that 21 times in a row to equal 514 days, I would make $84. But if I just sold one 514-day call, I would only make $36. I make way more than double by selling the short-term option. Makes sense? Does that make sense? Smart guys like Dirk, they picked up on this nuance right away. I forgot. I actually came up with this, but John adjusted the numbers. I thought he goofed up, but he didn't. My brain just went crazy. All right, Baron's got it. Dirk's got it. Okay, we're good. We're good. But like I said, Ben's got it. Like I said, though, I want to give you the bonus content. This is selling a pretty close to the money option. What if I sold the 255 strike? Well, if I sold them at 36, if I sold the 255 strike on a 514-day option, I'd make $27.65. But if I sold the 24-day options at 36 and I did that 21 days in a row, 0.36 times 21, I would only make 750. I would make 1/4 of what I would make selling the longer term options. Does that make sense? I hope so. This is an extremely important bonus lesson that you're getting. That thing about shorter term options making more money if you sell them, it's only true for near the money options. When we go out of the money, that relationship changes. Yeah. Yeah. So we always want to think about that. And you can look at theta, or you can just kind of think about it the way I just showed you. Next, choosing the next about choosing the expiration cycle. Buying more time, sell less time. If they're near the money and we're buying, we want to buy long terms and sell short terms. If they're out of the money or in the money, we always want to go through that exercise we just went through or look at the theta. And sometimes if you go out to the leaps, they can have really, really wide bid-ask spreads. They're not liquid. And another thing, longer term trades have less certainty. And Baron, you're welcome. And this is something that I didn't have to put in presentations for like decades, but now I do. There's the leaps, they have row, they have interest rate risk. One of these days I got to do a presentation on row, but because it matters now. You know, they're talking about, and they're talking about it goes back and forth. Everybody in Washington's crazy, right? But talking about bigger cuts in the interest rate. If they were to do a bigger cut in the interest rate, like 50 basis points, that can have a really big effect on longer term options. I remember one day when I was a professional trader, because I would have, professional traders can have really big positions. And every morning I would look at my statement, because I get a statement every day, and just double check that all my trades are right and that my money's right. And there was one day where I'm like, how did I lose $10,000? What happened here? You know what it was? They changed the interest rate overnight. I don't remember if I didn't know or I forgot, if I was coming back from vacation. I forget the scenario, but this is a true story. And I was like, I was like, geez, I didn't realize that I was going to lose $10,000 on this rate hike or cut or whatever it was back then. It was just because I had so many options on that row mattered. And they were longer term options. So, there's a lot of factors with options at the highest level. If you want to be great at this, there's a lot of factors that you've got to take into account. And the more factors you take into account, the more money you're going to make. In the book that I'm writing right now, Build Wealth with Options, in the chapter that I'm writing, I just typed this sentence last night. Nowhere is there a greater direct relationship between knowledge and profit than with option trading. Nowhere is there a more direct relationship between knowledge and profit than there is with option trading. The more you learn, the more you earn, baby. Okay, so that's choosing the expiration. What about the strike price? Does it really matter which strike price you choose? Because there's a ton of strike prices. I mean, you look at something like Apple or SPY. I mean, there's a lot of stocks. Palantir. There's like scores of strike prices. In the money, at the money, out of the money, way out of the money, close to the money, somewhat far from the money, somewhat in the money. Is there a right answer to which strike price to choose? Okay, so there's a trader, Brenda. Is there a Brenda here? Is there a Brenda in the room? I don't remember seeing a Brenda. There might have been. If there is a Brenda, I'm sorry if I didn't see it, but you didn't ask any questions today, so I wouldn't know that. That's why you got to participate. So Brenda is a directional trader. She buys calls or puts, and she looks for slow, steady trending stocks over a 3-month period. So Brenda decided to buy a far out of the money cheap call because she wants to reduce her risk, not pay so much. Is Brenda doing a smart thing here? Or is there a problem? Well, Brenda's rationale was that the calls would profit if the stock goes up. That's what they're supposed to do, right? But far out of the money calls have small deltas, which means when the stock goes up this much, they only go up this much. And over a long period of time, like 3 months, time decay, theta, could slowly eat away any directional profits. She has a high break-even price. It's kind of a same way of really saying what I already said in Greek terms. So her trade was kind of flawed. She could be right and still lose money. So let's look at her idea here. So she thinks she's got a 3-month time horizon. She thinks this stock is going to go to 45 bucks. She wants to save some dough, maybe buy like the 45 strike calls. She pays $1.72. So every dollar that the stock goes up, she makes only about a third of that, 34.5 cents. But as far as theta goes, she loses 2.5 cents every day. I mean, this stock is probably around like 40 some bucks. If it goes up $5, all she's really going to make is $1.50, a third of that. But theta over 30 days, if you assume a straight line theta, and it probably gets a little bit bigger over time because it's not that far from the money. I mean, 30 days times we'll make it 2.5 cents. She loses 75 cents on theta. And if it does get a lot bigger over time, she might lose $1. She might lose the whole $1.50. And in fact, what's the break even here? Well, the break even is $45 minus $1.72. Or no, plus $1.72. The stock would have to go above 46.72 just for her to break even. So there's a lot of criteria to consider here when choosing the strike price. First of all, delta. The reason Firstrade gives you a screen that has the Greeks on there is because you got to look at them. The Greeks are like the dashboard on your car. Could you drive without looking at the speedometer, temperature gauge, the gas gauge? Probably run out of gas if you couldn't look at that. If you didn't know how much gas is in your car, you'd run out of gas. Tachometer, I mean, with automatic transmissions, that's just sort of like a eye candy thing, but drive a stick shift. How many people here drive a stick shift? Anybody drive a stick shift car? Manual transmission? I bet Two participants raised their hands. And Afalabi says yes. That's like 5% of the people here. You don't but can? Okay. Oh, so okay. So now I'm going to assume that's four. If you guys didn't raise your hand and just answer in here, that's like 7%. That's more people than I thought. I made my kids learn how to drive on a stick shift. That was the deal I made them. I said, look, here's the deal. We live in the suburbs, south suburbs of Chicago. We're about 35 miles from the Chicago Board of Trade. I said, when you can drive a stick shift to the Chicago Board of Trade building, you can get your license. They got to drive through our suburban streets. They got to drive on the expressway, and they got to drive on city streets. They did it in a stick shift. And now none of them ever wants to drive a stick shift again. But they can, which is the important thing. But I know my kids think I'm mean, but that's right. I love them. It's tough love. Got to be cruel to be kind, right? Somebody said that. Who said that? Jackson Brown? Okay. So anyway, yeah, if you're driving a stick shift, you need the tachometer too. You need to look at the gauges. Otherwise, you're going to have some problems. Well, if you trade options, you're going to have to look at the Greeks. Otherwise, you're going to have basically the same problems. I mean, if you never look at delta or theta, that's like not looking at the gas gauge. You're going to run out of gas at some point. You're going to be late to your meeting or your date or whatever it is. You're in trouble. You also got to know the break evens. You got to know not just, hey, I think the stock is going to go up over 3 months, but you got to set a target, a magnitude of the move. Because if you think the stock's going to go up $1, well, that's one thing. If you think it's going to go up $20, well, that's a whole different strike you're picking. You got to look at the bid ask spread with liquidity. It's going to matter too on the strike price. If it's an in the money call, it might be a really wide bid ask spread. All right, holding on to losing trades too long. Oh, this is a mistake everybody made. You have made this mistake before, unless you're brand new to trading, and then you were going to make that mistake before watching this class. Now you won't. Let's talk about it. All traders have losing trades time to time. Is there anybody who never had a losing trade? I've never had a losing trade. Maybe not today, but I've had a lot of losing trades and a lot of winning trades too, right? You make enough trades, you're going to have a lot of both. All traders have losing trades time to time. Some traders actually have a high percentage of losers, but they still make money. It depends on your trading styles. How is it possible that a trader can have a lot of losers and still make money? Well, maybe they cut their losses short. How about this trader? Charlie. Anybody watch Lost? Charlie. Okay. So Charlie is a long call trader. He likes the limited risk of long options. Hey, if I buy an option, I can only lose what I pay as opposed to selling naked puts or calls. He holds long calls all the way until expiration. And a lot of the time, it doesn't make it to the strike price and he loses 100%. He scratches his head and says, what am I doing wrong? Well, Charlie's rationale was that he'll win on some and lose on some, and hopefully the winners beat the losers. But we all know hope is not a strategy. He didn't consider that he has more control over his losers than passive management, than just waiting until expiration. This sort of process that Charlie's been using is fundamentally flawed. So let's say Charlie is looking to, thinks Nike's going to rise over time. So he's looking at the 75 strike calls here. And he buys some, right? Maybe the stock is at 78. He's bought the 75 strike call. But he wants to automate his losers. He bought the call at $4.25. If the stock falls, and if it's below 75, I mean, this is an in the money call, but if it's below 75 at expiration, he can lose a whole 425, everything he paid for it. But what if he sets a stop? He sets a stop to sell this call that he just bought at 350. Now, wait, why would he want to sell lower than where it is? Because it's a stop. If the stock goes down and he's losing on his call, he'll stop the loss and sell what he bought at 425 at 350 and therefore only lose 75 cents. 75 cents is 20% instead of maybe losing 100%. And he sets it good GT90. That's good till 90 days from now. You know, this call doesn't even have 90 days till expiration, probably. So basically, it's good till he cancels it or until it gets filled or till it expires. Automate the loss. Other criteria. Whether limited or unlimited loss potential on a trade, we should always try to mitigate a loss. We can't always cut our losses because even if we use a stop loss, if the stock gaps, stop loss doesn't really work. And with spreads, we tend to not use stops. There's some more bonus content. If I were giving this to just, regular folks on the street, I wouldn't even expound on that last bullet point. Market Taker family members here who attend the Firstrade webinars every week, you get the bonus material. If you're trading a spread, you never want to use a stop. Whoa, what does that mean? We don't manage our risk on spreads? No, that's not what that means. Instead, we set an alert in their websites that you can use to set alerts, or if you just look at it every day, if it's a credit spread, you set a rule where, hey, if it goes through the strike price, I close the credit spread and take a loss. Debit spread, you just set some point. If it goes through this point, I'm going to take my loss. And you manually enter it because if you use a stop on a spread, it trades at the absolute worst price. Okay, so letting your losers run. What about taking your profits too soon? That can be a problem too. There is a fallacy out there. Nobody ever went broke taking a profit. I've used that line before, but, well, there's some truth to it, but there's some fallacy to it as well. To make money in the long run, traders must have some combination of more winners than losers or bigger winners than losers or both. You can have more losers than winners if your winners are significantly bigger than your losers. A lot of people have that trading strategy. Or you can have bigger losers than winners as long as you have a lot more winners. So let's explore this. A trader, Sasha. I don't think we have it. Do we have a Sasha here? Is there a Sasha in the room? Sasha has a very high percentage of winners, but is down money on the year. Is there a problem here with Sasha's strategy? Maybe. Apparently, if Sasha has more winners than losers, And it's still down money. That means the losers are wiping out all the winners. Knowing all traders have losers that draw down the account, Sasha must aggregate winners that more than make up for the losers. Got to balance that winner versus loser, size of winners, number of winners versus losers, size of winners versus losers. You got to have some sort of balance. So, okay. Maybe Sasha bought these Nike calls we were talking about and maybe entered that stop, or maybe didn't. But Sasha wants to make sure to get out for a profit. So Sasha puts in a limit order to sell maybe half of them at 550, take a 75-cent profit. Puts that in GT90, so basically good for 90 days is this order. And if Sasha's right, end up with a 75-cent profit. Now, if Sasha always has more winners than losers, 75-cent profit on these, and maybe there's a stop too, 75-cent loss on those. So either makes 75 or loses 75. If there's more winners, Sasha wins in the long run. This is one technique to set profit-taking limit orders. Who was it? Gordon Gecko said greed is good, right? Well, greed is not always good. But in some elements of trading, it can be helpful as long as you keep it in check and don't let it become an emotion that takes over. We have to be sort of greedy on long outright options. I think that taking a 50% profit or something like that on maybe the first half and more like 100% on the second half is reasonable. Because long options, you tend to lose more than you win. Short options, you tend to win more than you lose. Take most of the max profit on credit spreads and iron condors. Shoot for 75% of the max profit potential on short options. Or maybe take profit, 40% profit on some, 75% on the others. Because you're going to have more winners than losers, you can afford to take smaller profits. Cut your losses short, let your profits run. That is trading. Also, don't wait, or you don't want to hold your winners too long. How about not trading with a plan? There's two parts to every trade, getting in the trade and getting out of the trade. Opening the position, getting in, determines what your profit potential is, what your loss potential is, what your probability of success is, but management makes money. Closing the trade determines decisively whether the trade is a winner or a loser for real. Opening, it just gives you your stats. Closing literally locks it in. How about James? There's probably a James here, right? We got any Jameses in the room? James, are you here? No? Okay, no James? All right. I bet there's a James here. James is hypothetically a one-on-one coaching student with Market Taker Mentoring. Had a debit call spread, and the trade was losing. So in our one-on-one coaching session, I said, well, where do you plan on taking your loss? You're down on this trade. Where do you plan on taking your loss? James's answer was he didn't have an answer. He was just kind of hoping in the heat of the moment he'd know. Actually, he wasn't even hoping that. He was just hoping that it turned around. Hope is not a strategy. He typically exited winners and losers in the heat of the moment based on emotion. James was losing money when he came to me. James is what they call in Hollywood a composite character. I've had 100 Jameses over the years. So maybe James is looking to buy these calls. And what? Sell these calls? I don't know. It doesn't matter. You know, want to know what does matters? I reminded you of a great quote. Cannot remember the author, but all right, let's hear it, Robert. Let's hear it. I love great quotes. All right. So know your exits before entering the trade. And there are two: your target profit and your target loss. Write your plan down. If you are old fashioned, you can write it on a piece of paper. I say that with love because, in a lot of ways, I'm old fashioned. Kathleen makes fun of me all the time because when I go to the bank, well, first of all, I go to the bank, right? There's a lot of people who've never been to a bank. It's all online. I actually go there and I walk in the door and I say hi to the people and they, oh, hi, Dan. Most people just do it online. I'm old fashioned in some ways, but so if you're old fashioned, you can write down your trading plan. Now, when it comes to trading, I can't afford to be old fashioned. So I keep spreadsheets on Google Sheets and Google Docs to write down plans and such. Plans can be simple or elaborate. Trading plans require discipline. It's not enough to have the plan. You need to stick with it. Robert, oh, here's the quote Robert was talking about. Hopes, wishes, and dreams are not good investment strategies. What does John Kamisic say? He says, oh, that's a different quote. Here's John Kamisic, he's the ex-Goldman guy. He does a lot of our one-on-one coaching. He says, if ifs and buts were candy and nuts, every day would be Christmas. That's a good one. He says that to some of our one-on-one coaching students too. John's mean. You think I'm mean for making my kids drive the stick shift to the Board of Trade building? No. John, he whips you into shape. He is not for the faint-hearted. He is very nurturing and he cares, but he gives you tough love sometimes. All right. Anyway, so yes, trading plans require discipline, and sometimes a disciplinarian to hold you accountable. All right. So using the wrong option strategy. Okay. Ooh, let's talk about that. There are a ton of different option strategies: covered calls, cash secured puts, time spreads, credit spreads, debit spreads, straddles. Some are bullish, some are bearish, some are direction neutral, some are pro volatility. Can a trader pick the wrong strategy? Absolutely. Let's take a trader, Bill. Bill called me for help. He'd been losing money. One friend told him that the best stock to trade is Baidu. Here, we got to change that. I I I listed this present. Baidu is here. How about one friend told him the best stock to trade is Palantir, highly volatile. A different friend told him that the best strategy to trade is the Iron Condor. Is there a potential problem here? Yeah, Bill didn't understand that he needed to match the strategy to the market opportunity. He traded a neutral oriented strategy on a volatile stock. Doesn't match up. The trade was close to max loss one day after he put the trade on, and it's just poor strategy selection. So, say this person is looking at another wild stock, Nvidia, which, like, since April went from 95 to 182, basically doubled in five 5 months, with some pretty big dips, $10 dips here, or pops here or there too. So we got to start forming a forecast. And then we've got to start thinking, well, what's the volatility? Oh, the volatility is maybe pretty high in this expiration, or pretty low in this expiration, pretty high in this expiration. Um, do we got to do our research? Look at the news in there, read their 10Ks and such, right? Maximize our probability. We want to let the market tell us what strategy to trade. Is this a credit spread strategy? Is this a straddle strategy? Well, in order to know that, we've got to know what our forecast is. In order to know that, we've got to do our research. Always find 3 ways to trade an opportunity and pick the best one. How about this one? Misallocation of capital. Position sizing is paramount to trader success. Trading too big or too small can be the death knell for a trader. Take Javier. Javier started with a $20,000 account. He wanted to grow the account fast. He traded maximum margin on one trade every time. Is there a problem here? Of course there is. He was way too aggressive. I mean, being aggressive can be okay, but he had all his eggs in one basket. He took maximum leverage on an already leveraged instrument. Options are already leveraged to begin with. He lost 80%, $16,000. This is actually, all of these are basically true stories. This one I remember. And this is kind of a composite character too. There wasn't just one person who came to me for one-on-one coaching like this. A lot of people do. It's terrible. Don't be Javier. We need to look at our cash balance, our margin balance, short balance. Like, brokers give you all this information, not for fun, not because they like to clog your brain and eyeballs with numbers. It's because all these numbers are important. You need to know what all these numbers mean and what they do and what they're for, and put them to use. Look, you should always keep 20 to 50% of your net liquidating value. That's the whole account value, cash plus positions. 20 to 50% should be in cash reserves. For those of you who are newer to options, that should be closer to 50% at least. Those of you who are pretty experienced, okay, as long as you got 10% or well, 10 to 20% in cash reserves, you're good. The amount of cash reserves should be based on your risk tolerance, experience, what type of strategy you're trading. And you should diversify your option trades. Some should be positive delta, some should be short delta, some should be long volatility, some should be short volatility. Trading too big can lead to leveraged losses, bankrupt fast. Trading too small, once you're experienced enough, I mean, you should start out small. But once you're proved to yourself that you're making money, it can have too small of an impact on your bottom line. You can underperform the market. All right, friends, that's everything that I have today. Holy cow, we covered a lot. I figure we covered like so many important things. All right, next week, friends. Oh my gosh, next week is October. Tomorrow's October. Jeez Louise. This year's flying by. Well, we're going to talk about how to use delta to maximize leverage. Oh boy, that's an important one. All right, friends. I will see you tomorrow. Have a great rest of your day. Trade smart. Bye, friends.